When it comes to getting a mortgage, there's a lot of different factors that go into determining exactly what interest rate you'll qualify for. But by far, the biggest factor is going to be what your credit score is. So in today's lesson, I'm going to go over a specific example showing you how much more you'll pay if you have a low credit score versus a high credit score, and everything in between, and some things you can do to make sure you get the lowest interest rate possible on your new loan. Hey, it's Robert Weinberg, and on this channel we empower people to take control of their future through expert mortgage and financial strategies. In this lesson, we're going to talk about how your credit score affects the mortgage interest rate that you'll qualify for. The difference between having a 620 credit score and a 740 credit score could mean as much as 1% or more in the interest rate that you qualify for. Now, depending on the type of loan that you're actually applying for, it's going to determine how much of an effect it actually has. So conventional loans, those backed by Fannie Mae and Freddie Mac, have the highest interest rate disparity based on credit score, whereas FHA and VA and government-backed loans, while they do still get affected by the credit score, it's not as large of a disparity versus a conventional loan. So I want to show you this example here of a conventional mortgage, somebody who's either buying a home or doing a rate and term refinance to reduce their interest rate with 20% equity in the home or a 20% down payment and a $200,000 loan amount. So if you had a 740 credit score, you'd qualify for a 3.99% interest rate, and your payment would be $953 a month. And this is just principal and interest payment. These are just examples. These are not specific interest rates that are available today or for your particular scenario. So that $953 payment is fine, but if you go down just to a 720 credit score from 740, you would pay 0.8% more in interest rate, which would mean your payment, instead of being $953, would be $969. Now, if you had a 660 credit score, your interest rate would be over 0.5% higher. It'd be 4.875. Your payment would go all the way up to $1,058. And on the lower echelon, if you have a 620 credit score on a conventional mortgage, you'd be paying a 4.99% interest rate, and your monthly payment would be $1,072. So you can see the difference between that 620 credit score and a 740 credit score on the exact same loan, the exact same property, it's $119 per month. And you may be looking at that saying, oh, $119, that's not a huge difference. But you know what? You multiply that out over 12 months and over several years, you can see it can end up being tens of thousands of dollars over the life of the loan. So what can you do about it? Well, we always talk about getting credit ready. Before you go to refinance or buy a property, you really want to get with a mortgage advisor as early as possible to have them just do an initial scenario with you, a pre-qualification, so to speak, review your credit reports in depth, and make sure that you're in a good spot with your credit. And if there's things that can be done, you want to do that well ahead of actually applying for a loan, because it can take some time to pay down debt or take care of accounts that need to be disputed, deleted, etc. So that's one thing you can do. The other thing is, if you end up getting a mortgage while your credit's lower, you can always go and look at refinancing down the line, as we talk about doing an annual review and whatnot on your loan, getting with a mortgage advisor on an ongoing basis to make sure that you're in the best loan for your needs. So with that said, you might have bought a house a year ago or refinanced a year ago when your credit score was only 620. But now you've been doing some work, you've built it up where you're now in the high 600s or in the 700s. Now you can qualify for a better interest rate and a better program. So this would be a good time to look at refinancing. So it's one of the major benefits of having a closed-end mortgage like those that we do here in the United States, is that you have the ability in most cases to prepay and pay off that loan early through refinancing, and that allows you to take advantage of these scenarios that could occur with you having a higher credit score and being able to qualify for a lower interest rate. So I hope that helps. I really appreciate you watching. If it's your first time here on the channel, go ahead and hit the subscribe button and also ring the bell so you get notified on all of our future content. You can follow me on my social media platforms, and feel free to call, text, or private message my office directly if I can be of assistance to you or anyone that you know. Talk to you soon, and take care.